Hello, and welcome to the April 2024 edition of the U.S. Energy Insights. I am your host, Pamela Munger, and I'll be looking at the latest trends and market conditions within U.S. and global energy and sharing actionable insights powered by Vortexa's tracking analytics. This month, we'll take a look at supply factors influencing crude prices, demand factors showing a sluggish Q1, and an insight into Mexican crude exports. Now, much of the market is asking what the expected oil price levels will be if geopolitical tensions in the Middle East calm down. Now, although it's widely accepted that fear and geopolitical tensions play into the short-term elevation of crude, I want to look at a few factors that are more likely impacting the physical markets. Let's start with inventories. Global crude onshore inventories are at the bottom of the 8-year range and well below 2023 levels. The utilization of storage tanks are also well below the 8-year range. Now, while crude at sea is nearing last year's volumes, which are 20% higher than the 8-year average, this is somewhat mitigating the lack of inventories. Now, the inventory narrative exists amid a backdrop of OPEC cuts and the likelihood that OPEC Plus will extend the cuts of 2.2 million barrels per day through the rest of the year. Now, if a supply shock were to occur, then we could see higher prices due to a shortfall of a buffer in the system in the near to medium term. Now, considering that there's around 5 million barrels per day minimum of OPEC spare capacity, that could be turned on, especially from Saudi. However, that would run counter to the current OPEC Plus policy of assessing demand and adjusting supply accordingly. Now, while the market is focused on OPEC Plus cuts, we actually see that non-OPEC Plus exports are much higher than last year. Strong examples include the US, Brazil, and Guyana, and these countries have added almost 500,000 barrels per day this March compared to 1 year ago. This rising supply from non-OPEC will do two things. It will take market share and naturally help keep a lid on prices, even if geopolitical tensions are heating up. Now that we've looked at supply factors, let's move to some global demand indicators. A unique freight indicator for consideration is that we have seen no increase in ballast vessel speeds to pick up cargoes from main crude exporting countries. This could indicate a lack of increased purchasing from refineries. Crude freight rates are currently below or around 2023 averages, and voyages are lower year on year. Those factors combined with lower ballast speeds to the main exporting hubs gives us an indication that crude price increase is not demand side driven. Now, taking a look at China, despite the recent positive PMI indicators, the month of March saw an implied throughput increase of 200,000 barrels per day, which is notably lower than the 650,000 barrels per day and the 1.17 million barrels per day recorded in the same period in the past 2 years. This is reflecting subdued demand, which is below seasonal norms. India, on the other hand, is doing quite well, investing in large infrastructure projects, which are increasing the use and demand for diesel. And as we move closer to the US gasoline season, it is expected to be a relatively strong one. Gasoline margins are firm as we start the lead up to the summer driving season. However, if we take a look at a few of the global macro indicators, global diesel and gasoline arrivals are coming in lower than last year's levels for March. Now, at the same time, global import demand indicators for jet kero and naphtha are also down markedly versus a year ago. Now, another small but relevant discussion point, especially in the US election year, is if we see continued reduced crude oil shipments from Mexico to the US, as they are hitting their lowest export levels in 5 years. So seaborne crude exports out of Mexico fell for 3 consecutive months in March, with a decline of 20% observed month on month. Although news suggests this decline coincided with the startup of Dos Bocas refinery, we also observe a recent and sharp inventory drawdown. If lower exports continue, this could impact the heavy sour crude markets, where 150,000 barrels per day supplied to Asia could be lost. The US, however, can replace Mexican crude with Canadian heavy barrels, which means that overall there will be less available on the export market. Now, this, along with OPEC cuts, could tighten the heavy light spread. Well, that is all we have with you for the April edition of the US Energy Insights. Thank you so much for watching, and hope to see you again next month.